We all use money. It's a fundamental part of our daily lives, woven into the fabric of our routines and interactions. It's how we buy our morning coffee, pay our rent, and settle our bills. From the mundane to the significant, money is the medium that facilitates our transactions. We even use it to bribe our kids to behave in public, rewarding them with a few dollars for good behavior. It's a tool for teaching value and responsibility. But how often do we stop and think about where that money comes from? Do we ever ponder the journey of those bills before they reach our hands? It doesn't just magically appear in our bank accounts, does it? There's a complex system behind the scenes ensuring that money flows smoothly through the economy. Don't worry, we're about to dive deep into the intriguing world of money printing in the good old US of A. This process is more fascinating than you might think. Believe it or not, it's a carefully orchestrated process involving more acronyms and government agencies than you can shake a stick at. From the Bureau of Engraving and Printing to the Federal Reserve, each plays a crucial role. But fear not, dear reader, this essay is here to demystify the whole shebang. We'll break it down step by step, making it easy to understand. We're going to break down exactly how those crisp bills end up in your wallet. From the initial design to the final distribution, every stage is meticulously planned, and explore the economic forces at play behind the scenes. We'll look at how monetary policy, inflation, and other factors influence the value and availability of money. So buckle up and get ready for a journey through the fascinating world of money. First things first, let's talk about the big cheese of the US financial system, the Federal Reserve, or as the cool kids call it, the Fed. Now, the Fed doesn't actually print the physical bills. We'll get to that in a minute. Their job is much more high level, like the conductor of a money printing orchestra. The Fed decides how much money needs to be circulating in the economy. Too little money, and things grind to a halt. Too much, and you get inflation, where your dollar doesn't go as far. It's a delicate balancing act, folks, and the Fed is constantly monitoring the economy to get it just right. Once the Fed gives the green light, it's time for the Bureau of Engraving and Printing, BEP, to work its magic. This is where the rubber meets the road, or should we say, where the ink meets the paper. Located in Washington, D.C. and good old Fort Worth, Texas, the BEP is responsible for designing and printing all those fancy bills we know and love. The process is surprisingly complex, involving specialized inks, intricate engravings, and a whole lot of security features to keep counterfeiters at bay. Each bill goes through multiple stages of printing and inspection before it's deemed worthy of joining the ranks of legal tender. Now, what about the jangling coins in your pocket? Well, those are handled by a different branch of the government, the United States Mint. With facilities in Philadelphia, Denver, San Francisco, and West Point, the Mint is responsible for producing all those shiny pennies, nickels, dimes, and quarters. The Mint follows a similar process to the BEP, using specialized metals and intricate designs to create durable and recognizable coins. And just like the BEP, the Mint takes security very seriously, incorporating features to deter counterfeiting. Section 5. Controlling the flow, the Fed's bag of tricks. So, we know the Fed decides how much money to print and the BEP and Mint handle the actual printing. But how does the Fed actually control the money supply? This is a crucial question because the amount of money circulating in the economy can have significant impacts on inflation, employment, and overall economic growth. The Federal Reserve, often referred to simply as the Fed, uses a variety of tools and strategies to manage the money supply and ensure economic stability. Well, they've got a few tricks up their sleeves. These tools are designed to influence the amount of money that banks can lend, which in turn affects how much money is available in the economy. By carefully managing these tools, the Fed can help to smooth out the economic cycle, preventing booms from becoming bubbles and busts from becoming depressions. One is called reserve requirements. This is a regulation that sets the minimum amount of reserves that a bank must hold against its deposit liabilities. Essentially, it's the amount of money banks are required to keep on hand at all times, either in their vaults or on deposit at a Federal Reserve Bank. By adjusting this requirement, the Fed can influence how much money banks have available to lend out. For example, if the Fed lowers the reserve requirement, banks can lend more of their deposits, which increases the money supply. Conversely, if the Fed raises the reserve requirement, banks have less money to lend, which decreases the money supply. Another important tool in the Fed's arsenal is the discount rate. This is the interest rate the Fed charges banks for short-term loans. When banks need to borrow money to meet their reserve requirements, they can turn to the Fed as a lender of last resort. By adjusting the discount rate, the Fed can influence the cost of borrowing for banks. If the Fed raises the discount rate, it becomes more expensive for banks to borrow money, which can lead to a decrease in the money supply as banks become more cautious about lending. Conversely, if the Fed lowers the discount rate, it becomes cheaper for banks to borrow money, which can lead to an increase in the money supply as banks are more willing to lend. By raising or lowering this rate, the Fed can make it more or less expensive for banks to borrow money, which in turn affects how much money they lend out to businesses and consumers. This can have a ripple effect throughout the economy, influencing everything from consumer spending to business investment. Through these and other tools, the Fed plays a crucial role in managing the economy. By carefully adjusting the money supply, the Fed can help to promote stable prices, maximum employment, and moderate long-term interest rates, which are the key goals of monetary policy. Section 6, Quantitative Easing, a Controversial Lifeline. Now let's talk about quantitative easing, or QE for short. This is a fancy term for a pretty unconventional monetary policy tool. Basically, it involves the Fed injecting massive amounts of money into the economy by buying up assets like government bonds. The goal is to lower long-term interest rates and encourage borrowing and spending. QE has been used in recent years to combat economic crises, like the 2008 financial crisis and the COVID-19 pandemic. It's a controversial tool, with some arguing it's necessary to prevent economic collapse and others fearing it could lead to runaway inflation. Section 7. Cash is king. Why we still need physical money. In this digital age of credit cards, debit cards, and contactless payments, you might be wondering why we even bother printing physical money anymore. Well, despite the rise of digital transactions, cash is still king for many people and businesses. For one thing, cash is tangible. It represents a physical embodiment of value that many people find reassuring. It's also essential for certain segments of the population who may not have access to traditional banking services or prefer to operate in a cash-based economy. Section 8, Across the Pond. A look at the Bank of England. Now let's hop across the pond for a moment and see how our friends in the United Kingdom handle money printing. The Bank of England, often called the Old Lady of Threadneedle Street, plays a similar role to the Fed, determining how much money is needed in the UK economy. The Bank of England also takes a slightly different approach to printing money. While the Fed primarily focuses on managing the money supply to control inflation and economic growth, the Bank of England also prints money to replace worn-out notes and meet fluctuations in demand, such as during holiday seasons. Section 9. The bottom line, your wallet and the economy. So there you have it, folks. The money in your wallet is more than just paper and metal. It's a symbol of the intricate economic system that governs our daily lives. The next time you pull out a dollar bill or a handful of change, remember that each piece of currency has a story. Take a moment to appreciate the complex and fascinating process that went into getting it there. From the design and selection of materials to the intricate printing techniques, every step is meticulously planned and executed. From the Fed's decisions on money supply, which influence how much money is circulating in the economy, to the policies that aim to stabilize prices and maximize employment, to the intricate printing processes of the BEP and Mint, where each bill and coin is crafted with precision and care, a lot goes on behind the scenes to keep the wheels of the economy turning. Financial analysts, economists, and policymakers all play crucial roles in this complex system. Understanding how money is printed, from the selection of paper and ink to the final inspection, and how the Fed manages the money supply is crucial for making sense of the economic forces that shape our world. These forces impact everything from the cost of goods and services to the availability of jobs. It affects everything from interest rates, which determine the cost of borrowing money for things like homes and cars, and inflation, which impacts the purchasing power of your money, to employment and economic growth. By understanding these elements, you can make more informed financial decisions and better navigate the economic landscape.